Hey, Karen Rands here, back with another insight nugget about angel investing and to give you an invitation to join the upcoming portal of education for learning how to become an angel investor and crowdfunding investor, uh, the Compassionate Capitalist Wealth Maximizing System. It's going to go live here in not too distant future. And you have an opportunity to sign up for free on the pre-sale before it goes live, dothedeal.org. But today we're talking about angel investing versus stock market investing. Over the last couple of days that I've done these live, I did Bitcoin comparison, and I talked about the why more people don't know about angel investing and are using it as a part of a wealth creation strategy. And then yesterday was real estate. Today is the stock market. So a couple of key points that you need to understand. The same equity that somebody buys when a company is public, when it's retail, somebody else has bought it when it was wholesale, meaning they got it when it was a private company, and then that stock gained in value as that company took the money from investors and put it to work to build the value of their company. So they're starting out at a low value when they're still figuring things out. And then they get the product to market, they grow it, they grow their revenue, they beat the competition, they get really big, and they usually sell the company. But sometimes about 5 to 10% of the companies that get angel investment will go public. Okay. And that means they then initial public offering, that's the IPO, which is different than what I refer to, and other people, you might have heard this term, direct public offering. Okay. Direct public offering is what we do on the crowdfunding platforms, where a company is directly soliciting, general solicitation to the general public, their offering. And that was the big thing. That was the big rule change that made it legal for entrepreneurs to solicit investments from people they didn't know to purchase a piece of their equity in their company. So that's fundamentally that they're the same. It's the equity part. It's shares in the company. So it's the same thing. The difference is that one's really low value, goes all the way up. You've heard the term pink sheets and reverse mortgages. They're very similar to the concept before angel investing or direct public offering, crowdfunding investing in these types of companies was available to be done. A lot of investors and even companies would struggle they would try to raise capital from what they called pipe money, private investments into public entities. And so pipe money, kind of like private equity money, like the ones that are an alternative to VCs for growth strategies, they would invest in these companies with the idea that they're going to grow their market cap and drive their price up from whatever it was, penny stocks. My dad used to always invest in the penny stocks, and those are usually thinly traded. They're like pink sheets. You may have heard that term. That comes from the world where they were on a bulletin board. They weren't exchanged. They weren't big enough and viable enough to be on the New York Stock Exchange or the NASDAQ or any of that kind of stuff. So they were pink sheets. You were on bulletin boards. And that goes way back history, where they actually had like a bulletin board of pink sheet companies. And so sometimes people would want to have the potential for a big uptick. So they would buy those stocks. Because we went from 10 cents to 20 cents, you doubled your money, right? And so, that's kind of some of the folklore and history behind this, but that emotion of thinking you're getting a really great opportunity applies to investing in entrepreneurs before they've gone public. All right. Because you're buying wholesale, selling retail. And when a company first initials their public offering, the shares that are being offered to the public, to the retail investors, are company shares. So the company benefits, raises a large amount of money, usually when they do that. It's going to take them to a whole nother stratosphere. But also all of their existing shareholders, except for when they have some blackout periods. That's a, the IPO issuer, the market maker will make that decision, will help with that. The legal, there's laws around that. But for the most part, they get to sell in it as well. In a future episode, we're going to talk about Reg A Plus, and Reg A Plus has become sort of an alternative for companies that can't quite go public, don't want to do pink sheets, and reverse mergers are just bad news. In my own limited knowledge, I've not seen a single reverse or a single pink sheet that has been successful. And there's a whole nother concept on that I'll cover in the course. Again, here you go, dothedeal.org, right? So but the main thing, I want to show you some charts for you to understand. Stock market is always a good place to have money in as part of a portfolio. Real estate, stocks, commodities like gold if you want. But my big thing, why I'm doing this, is to educate and inform so you can make a decision. Should you start including private equity of early stage companies, growth stage companies in your portfolio based on creating a diversified strategy for wealth creation? Okay. So, and the thing is that with angel investing, with this stuff, because of the nature with an angel group that comes in or the focus of that, you have a direct impact. This is where the needs come. The emotional side of angel investing comes in, because you're able to choose to invest in something that you find a company that is solving a problem that you're also passionate about, right? When you invest in a public company, you're not helping that company solve the problem. You're buying stock from another shareholder, unless you're part of an IPO. And IPOs, you have to be very, very wealthy to get in on the initial IPOs, right? So that's why it's a good thing to have this if you want to have an investment that has an impact. And the thing about stock markets is that there's so many things that are outside your control as an individual shareholder of anticipating when it's going to go down. It's hard to anticipate. But there's a lot of factors. There are external world factors, the Great Recession, pandemic, the whole thing, an Enron collapse, a giant collapse of some company will trigger a bunch of stuff, because all of these big market makers, these hedge funds, have a lot of money in these stocks. And so they have to maintain a balanced portfolio to their own investors. So they move it around, and sometimes that will trigger something else happening, right? And that'll trigger because other money moves along with it. There's a lot of indicators in general public portfolios that if a stock drops below a certain amount or has a change of a certain amount, it will cause other stocks to sell automatically. It's just the way that computers and stock markets work together now. And so if you're not, individually managing your stocks, you may be subject to some of these fluctuations. And, it's a great, because you can be liquid, you can get out of the stock market anytime you want. Whereas with angel investing, owning private, you cannot. It is not a liquid stock. You cannot, there's a lot of rules around who you can sell it to, and how long you have to have that stock before you can then go and sell it to somebody else. Usually you have to sell it back to the company before you can sell it to anybody else. And it's whatever that valuation of that is at that time, or it's negotiated down. There are some entities that will buy stocks from stockholders internal, like when you have founders or early employees that have stock options, they'll choose to sell some of that stock sometime prior to an IPO. Micro Ventures is one of those platforms that does that. But let's look at the charts real quick before we wrap up here, because I thank you for paying attention. Right. I want to share this stuff with you, because this is really, I think this is important for you to see some of this. Right. So this is a chart of all different types of assets. Right. We got gold, we got property, we got cash, and how they, which one has performed the best over periods of time. And you can see here, there's times when property has performed the best. That's when it was recovering from the Great Recession. Stock market has bounced back. Properties bounced back. That's what they've done in that yield. high yield bonds performed really well when we were with cash, and cash performed really well, right? So you can kind of see where this happens. Like, but in the year in 2018, what happened? Stock market was down 8 points, right? Then you have it, you've had, you can just see there's all kinds of variation. So a full-on wealth creation strategy, and hopefully your wealth manager is open to the idea of all these different type of asset classes. What you don't see in here is angel investment money, private stock, private equity, private shares, right? They're not listed here because it was, I don't know, not known. We won't say it's a secret. We just say it's not known. It was not something that people talked about as a strategy for creating wealth. So you look at that, and part of what you want to know, I'm going to share this is showing the exits, right? So when you see, part of what I talk about in the book is that you've got a lot of people that money, in order to have a good strategy for angel investment, there's got to be an exit. There's got to be other money that's put into it. This is one of the things we're talking about in the class in judging a risk factor of an angel investment deal, is if they don't have the ability to raise the next round of capital. And so what you see here is that these are the exits of M&A who got merged, IPOs, right? IPOs every year, but sometimes it's bigger than other years, right? That's a lot of times has to do with the whatever the other sources of capital, what else is happening in the market. If it's not if the stock market is down, it's not a good time to go public. They'll wait another year for that. And then you've got the angel investment. I wanted to show this real quick. This is from a report, Risk Side of Capital Management, LLC. So this is showing, based on these other sources here. Let's see, can you see that? Okay. The internal rate of return out of their investments. And you notice it's not all of them are exited, right? Some of them are held on to a while. This company had equal had a 24% internal rate of return. And so that the big wins are what makes up for those base hits and the losses, because in a portfolio, there will be losses. Not every company succeeds. That's just the factors that influence their companies succeed is leadership. We talk about this when I talk about risk factors and identifying the red flags. It's soon to be a report coming out about that. But you have these risk factors that, and a big part of it is raising capital, leadership, the ability to scale, and get the rest of the capital, and anticipating, the direction of what they're building it towards to get to the optimal exit. Right. And then lastly, angel report. This is from the Angel Capital Association. Overall multiple of angel investors, 39% are less than 1x. So they're basically getting their money back. And 61% are greater than 1x. Okay, so that is that's according to all the angel investor groups. So just wanted to share all of that, share some of those insights with you, so that you would have a sense of the difference. Stock is liquid, stock market is liquid. Angel investment, crowdfunding investment, not liquid. Stock market is volatile, and a lot of it is outside of your control. Angel investing in private companies is risky because there's other factors that impede their ability to grow. But as we will talk about, and I've talked about in other videos, because of the new direct public offerings, it's a lot easier for companies to raise growth capital when they don't have access to the venture capital money. And then tomorrow, and so the factors and part of building a diversified portfolio, the angel profitability blueprint that I teach as part of my class, gives you the best of all the worlds, right? It gives you an annuity, very similar to what you would get with rental income from real estate, or a flip. There's strategies for that. So we build a balanced portfolio of that, along with shorter term returns, later stage equity, that like a Reg A plus, and they're going to be going public in the next year or two, where you can exit your money. You don't get a huge return, but then picking and choosing those that you think have the greatest potential to have a bigger exit, the 10x that we just talked about. And so go to dothedeal.org, sign up for the pre-sale of this so that you can get in on the intro class and start to learn whether you should, would, could become an angel investor, and go get the book. Right? That's one of the first things. If you want to start learning about this, buy the best-selling primer on this. And it even has pictures. So, and with that, tomorrow we are going to talk more specifically about angel investing and the categories of angel investing, and just some more stats about angel investing in and of itself. And with that, onwards and upwards. Happy Friday.